Hey everyone, welcome back to my fourth YouTube video. Today, we're going to be going over a little bit of how to choose a stock and what measures a certain stock. So these are the four or five most important things that I think are really important when looking at a stock. So first, obviously, is going to be the price of that stock. So the price of a stock is really just a measure of how much someone is willing to buy that stock for and how much the other person is willing to sell it for. So really, it's about the law of supply and demand. So basically equilibrium of buyers and sellers is going to set the stock price. Second, I think, is the PE ratio, or the price to earnings ratio. It's basically the ratio that is going to measure the earnings per share to the current share price. Now, sometimes PE ratios can be super high, meaning that company is probably overvalued, or sometimes the PE ratio is super low, meaning that company would be undervalued. Now, after that, the market cap or market capitalization is the total market value that company is worth. And it's measured by multiplying the number of shares that company has by the current price of each share. Now, the fourth is, I would say, earnings. So earnings is basically every quarter a publicly traded company has to come out with earnings. Now, if a company beats their projected earnings, the stock price is sure to go up. At these earnings call, there's also a lot of news that it comes out about that company. If it's good news, the stock price is more likely to go up. If it's bad news, more likely to go down. No. If a company beats on earnings, and what I mean when I say beats on earnings is it beats the analysis expectation for the company, it's for sure the stock price will go up. Now, while talking about analysts, it's actually goes perfectly with price targets. So basically, price targets are an analyst's projection of what a stock is going to be in the future. So if there's a $20 stock that $20 stock, and then it's morning before trading hours, and a big analyst who has a lot of popularity says this stock should be $60 stock. Once that market opens, the stock price is going to go through the roof, because if you have these super credible analysts who are saying that this price is going to go up, then more people are going to buy it. So when investing in the stock market, it's probably the most important thing is to just be patient. 98% of people who day trade in the stock market actually lose money. So what's most important is to slowly let your money work for you. Now, the best way to describe this is by using compounding interest. So it's expected, if you put your money into a stock, it's expected to increase about 8 to 10% a year. Now, if you let this go for 20 years, your initial investment is going to be worth a lot more than what it was. And it's important to know that this doesn't take days, it takes years. So it's important to be patient. Now, here's a little bit about the power of compounding interest. So these two guys are putting the same amount of money in, but one starts when they're probably 21 and the other starts when they're about 30. Now, by the time they're 67, Jack, the guy in the orange, has 2.55 million, while Blake, who started investing probably 10 years later, he only has 1.48. So that 10 years would led to a little bit over $1 million difference in their investment. So it's important to start early and be patient. Now here's a little lesson plan to go along with it: introduction, video, worksheet, review, and then questions. Thanks everyone for watching. Please remember to like and subscribe.